Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first AI's $1 trillion spending spree faces bubble warnings as circular revenue deals and vendor financing raise Wall Street concerns. So we'll discuss why this massive spending isn't translating to profits and what it means for the stability of sky-high tech valuations. Second, new US tariffs create an uncertainty tax on housing, squeezing homebuilder profits as their costs surge past consumer prices. We'll examine how this growing gap between builder costs and home prices may impact housing affordability and the construction sector's stability. Third, the US and Australia ink an $8.5 billion deal to build a non-China rare earth supply chain, sending commodity stocks soaring. We'll analyse why this friend-shoring strategy matters now and how it could affect the cost of the green transition and supply chain security. Are we in an AI bubble? According to former Intel CEO Pat Gelsinger, the answer is simple. His words, of course we are. The numbers behind that statement are staggering. According to former White House economic advisor Jared Bernstein, the share of the economy devoted to AI investment today is nearly a third greater than internet-related investments during the peak of the dot-com bubble. A while back, we contrasted that backdrop with an audacious claim from Broadcom's CEO that generative AI could add $10 trillion a year to the global economy, setting up today's tension between extraordinary promises and equally extraordinary price tags. Now, here's where it gets interesting. This pattern is eerily similar to what economists call the productivity paradox, first identified in the 1980s. The core idea is a puzzling disconnect. Despite massive investment in new technology, there's no immediate, measurable jump in economic productivity. We are seeing this again today. Continuing our last discussion about whether this will show up as real gains in total factor productivity, remember, some analysts, like McKinsey, see as much as a 0.6% annual boost, while others think the effect could be an order of magnitude smaller. That spread is precisely why today's spending faces such intense scrutiny. Take OpenAI. The company is involved in deals worth around $1 trillion, including a single $500 billion data center project. Yet, it's projected to generate only $13 billion in revenue, and as of last year was still losing money on its operations. A while back, we also noted OpenAI's move to pair with Broadcom on roughly 10 gigawatts of custom accelerators, and NVIDIA's up to $100 billion equity stake, a shift from shovel seller to mine owner that concentrates both performance advantages and financial risk. The entire bull case for these sky-high AI valuations rests on the promise of future productivity gains justifying today's massive spending. If a clear return on investment doesn't show up in the next 18 to 24 months, we could see a sharp reset in valuations. This massive gap between spending and profit is fueling a Wall Street showdown. We're seeing figures like BlackRock CEO Larry Fink arguing this is necessary capital for a technological revolution, while at the same time, Oaktree Capital's Howard Marks is saying he doesn't yet detect the mania of a true bubble. We previously noted this nuance. Not everyone sees outright mania, even amid eye-popping numbers. And, there's some data to support Marx's view. Unlike the dot-com bubble where almost every stock was rising, today's market is different. While a handful of giant tech stocks are hitting new highs, many other stocks are actually lagging or even declining. This suggests that investors are still cautious and a broad euphoric mania hasn't fully taken hold. There may still be a wall of worry for the market to climb, but that's not the whole picture. According to Ben Inker of asset manager GMO, we are seeing bubble-like behavior and circular revenue deals. He warns that the AI ecosystem has burned through the cash flow from giant tech companies and is now funding itself with debt and what he calls very strange deals between firms like NVIDIA and other money-losing startups. A while back, we described NVIDIA's evolution from shovel seller to mine owner. Inker's circular deals and vendor financing are part of that same web of entanglements that can make revenues look healthier than they are. So the thing is, what are these very strange deals? This often refers to a practice called vendor financing. It's essentially when a seller, like a chip maker, lends money to its customer, a startup, so the startup can afford to buy the seller's products. It creates revenue on paper for the seller and gives the startup crucial resources, but it also creates a fragile loop of debt. This shift from using internal cash to relying on external debt makes the entire ecosystem much more vulnerable to a sudden crisis of confidence, what economists call a Minsky moment, where the whole system could seize up if credit suddenly tightens. However, if you zoom out, you'll see another layer of strategy at play. This frantic investment isn't just about commercial opportunity. It's also being driven by a geopolitical AI arms race, primarily between the US and China. For the US, a private sector-led infrastructure boom is seen as a national security necessity. This ties the tech investment cycle directly to strategic policy, which can create distortions. We previously framed this as an undeclared arms race that's shifting from general-purpose GPUs toward custom silicon, a move OpenAI's Broadcom partnership underscores. For Chinese audiences, this is important because it means the AI build-out in the US might be creating supply capacity that exceeds purely commercial demand. If China's own AI development proves less of a threat than anticipated, or if geopolitical tensions cool, the justification for this level of spending could weaken, posing a risk to these investments. The conflict is no longer just about sky-high valuations, it's about a fundamental shift in how this boom is being financed. The key will be whether this mountain of investment, increasingly built on debt, can generate credible profits before the runway of funding runs out. Keep an eye on the quality of these investments. Are they going into tangible infrastructure? Recent data shows that major tech companies are projected to spend over $220 billion by 2025, with a huge portion going into physical assets like data centers and power infrastructure. As we noted earlier, AI queries can consume around 10 times the electricity of a standard search, and US data centers could climb from roughly 4% of national electricity use in 2023 to as high as 12% by 2030 figures that rhyme with those power demand nearly tripling projections. A building cycle grounded in physical assets is generally more stable than one based on speculative software alone. The world is watching to see if this mountain of investment can generate credible profits before the runway of funding runs out. From the dizzying heights of AI investment, let's ground ourselves in something more tangible, the housing market. And it turns out the financial pressures here are just as intense, though for very different reasons. One homeowner's budget for a new house just exploded by $150,000, a 50% cost overrun from $300,000 to $450,000. And this happened times before the latest round of major US tariffs even took effect. The situation presents a fascinating duality. On one side, you have the Producer Price Index, or PPI, which tracks soaring costs for builders on things like lumber and copper. On the other, the Consumer Price Index, or CPI, shows the final price consumers pay for housing is rising much more slowly. This means home builders are currently absorbing these massive cost increases, squeezing their profits. The problem is, this gap can't last. Either builders will be forced to pass these costs on, leading to another housing affordability crisis, or their businesses will suffer, potentially hitting their stock prices. Now, what really brought this to a head was the next development, new levies hitting imported timber, kitchen cabinets, and wooden furniture. While the White House states the tariffs will boost domestic manufacturing, economists are sounding the alarm. They warn this is the last thing an already weak construction market needs, especially as it's being laid on top of previous tariffs, including a 50% levy on both steel and copper imports. Interestingly enough, it's not just about the direct cost of the tariffs. There's a hidden cost that economists call the uncertainty tax. When businesses don't know what future trade policy will be, they get nervous and delay big investments. This uncertainty itself acts like a tax, slowing down construction and renovation activity. Recent data supports this, showing a drop in new building permits, right, as policy uncertainty has been rising. Believe it or not, the corporate fallout is already beginning. The furniture company RH, formerly Restoration Hardware, is now facing $30 million in new tariff costs and was forced to delay a design catalogue due to pricing uncertainty. For a company like RH, this creates a classic case of what's called retail margin compression. The company is stuck. Either they raise prices and risk scaring away customers, or they absorb the $30 million in costs, which directly hurts their profitability. This is the difficult choice many retailers are now facing. It's not just a high-end problem either. Even the budget-friendly retailer IKEA has warned it may be forced to raise prices. This is a real-time test of supply chain diversification. While companies are trying to move production to places like Vietnam or Mexico, these countries often don't have the capacity to absorb all the demand. The result? new bottlenecks, and potential price increases from those new suppliers, which could create its own wave of inflation, revealing the true cost of reorganizing global supply chains. The National Association of Homebuilders is calling this a major headwind for a challenged market. A policy centre warns that affordable housing projects could be hit particularly hard, as rising material costs may force developers to abandon low-margin projects. After all, affordable housing operates on razor-thin profit margins. The National Association of Homebuilders estimates that recent tariffs have already added an average of nearly $11,000 to the cost of a new single-family home. For a high-end custom home, that's a problem. For a low-margin affordable housing project, an extra $11,000 can be the final straw that makes the entire project unprofitable. Some economists say the new tariffs alone won't tank the market. But as one senior economist at Realtor.com noted, while it's not a catastrophe for home builders, it is another unwelcome problem. And these things do add up. Looking ahead, the key things to watch are builder profit margins in their upcoming earnings reports and the consumer price index for housing. If builder margins are collapsing, their stocks could be in for a rough ride. If they successfully pass the costs on, we could see a renewed spike in housing inflation, putting more pressure on interest rates. As with any market-related news, investors should be aware that conditions can change rapidly. This report is for informational purposes and is not investment advice. Speaking of supply chains and global pressures, that brings us to our next story, where the US and Australia are making a multi-billion-dollar bet to reshape the global flow of critical materials. A seemingly impossible collaboration became a reality this week, with the two nations inking a deal worth up to $8.5 billion to build a rare earth supply chain independent of China. A while back, we talked about how this partnership was moving from rhetoric to wiring real money into allied supply chains, about $1 billion slated to hit projects within the next 6 months, and how that takes the alliance to the next level, while putting Australia in a delicate balancing act with its biggest customer, China. This decision brings both significant opportunities and comes with inherent risks. It's a massive acceleration of a strategy known as friendshoring, collaborating with trusted allies to secure critical resources. When we place the West's current dependency alongside the goal of supply chain security, the contradiction becomes clear. S&P Global notes that China currently supplies about 68.5% of US imports of rare earth materials. Building new mines and processing facilities will likely raise costs for the green transition in the short term, but the long-term goal is to de-risk supply chains. The news sent shockwaves through the market, with shares of US-listed rare earth stocks jumping. One company, Cleveland Cliffs, soared more than 20% after announcing it was considering creating a new rare earth mining business. Continuing our last discussion, the situation this time is somewhat different. Watch for two telltales whether Beijing leans on the gallium divided by germanium-style playbook of surgical export or price moves, and whether Chinese imports of Australian iron or natural gas slow as a pressure signal. But while the resource sector is on fire, a very different story is playing out in big tech. Amazon Web Services, the leading vendor of cloud infrastructure, just spent a day grappling with a massive outage. The disruption crippled access to popular sites from Snapchat to Lyft to the New York Times. The company says services have returned to normal, but the day-long saga has raised serious questions. This development highlights a systemic vulnerability in our digital economy called cloud concentration risk. With so many organizations relying on a handful of major cloud providers, a single outage can have cascading effects. The concern is that future disruptions could have a much larger impact on GDP and even trigger costly government regulations. In stark contrast, it was a banner day for Apple. The stock rallied to all-time highs on reports of strong iPhone 17 sales in both the US and China. This suggests that premium brands like Apple can achieve what some analysts call geopolitical escape velocity. Their brand is so compelling that they can defy the broader trend of economic decoupling. For Chinese consumers, research from Counterpoint shows that sales of the base iPhone 17 model nearly doubled compared to its predecessor, thanks to significant upgrades at the same price point. One wealth management CEO said Apple's artificial intelligence efforts are creating a whole different story for the stock's outlook. The market momentum didn't stop there. General Motors blew past Wall Street's expectations, causing its stock to surge 8.5% in pre-market trading after the automaker lifted its full-year guidance. This points to a growing divergence in consumer spending. On one side, you have strong demand for credit-fueled durable goods like cars. On the other, reports from companies like Coca-Cola suggest softer demand for everyday staples. This creates what economists call a K-shaped dynamic, where different parts of the economy are moving in opposite directions, complicating decisions for central banks. From a new commodity arms race and a tech giant stumble to record highs and blockbuster earnings, the market is signaling major shifts in global power and corporate dominance. Disclaimer: this content is for informational purposes only and not investment advice. All financial information is subject to market volatility.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.